I bought SOFI 3.5 years ago. I'm down 70% on my position. The business has developed quite well and the CEO is buying his own stock. So it's time for me to first do a deep dive analysis. Second, to decide whether I should buy more, hold or sell the position. And third, it's time to reflect for me, what did I do wrong 3.5 years ago? Hello and welcome to Future Fortunes. My name is Christoph. This time I keep the stuff about the company really short. This is a new channel, so please make sure to like, subscribe and maybe comment if you like my content. SOFI was founded 2011. The goal was to make the refinancing of government student loans more affordable. Later on, they diversified into other traditional financial services, and in 2020 they bought Galileo. Galileo is a banking-as-a-service platform that enables customers like Shopify, for example, to offer payment solutions and to issue credit cards if they want and other stuff. At the first glance, everything looks great. Members are growing 41% year over year. The number of Galileo accounts also grew 23% year over year. Revenue, on the other hand, isn't growing anymore, at least for the last 3 quarters. Management expects Q3 to have a year-over-year growth of 17 to 19%. That would be below this quarter. And for the next quarters and next years, they don't give any guidance. And this is a really red flag. If a hyper-growth company stops growing, we saw this, for example, with Netflix and stuff, and PayPal, then the stock price will go south a lot. And because I hold the stock, I sometimes listened in to what the management was saying, and statements like these kept me from selling. I have to admit that. In Q4 2023, they said they expect a 20 to 25% annual growth rate throughout 2026. And they were very optimistic. Simply put, this growth only reflects the benefits of the investments we have already made in our existing businesses. That means there could be growth on top of that. 1 quarter later, in Q1 this year, 2024, they were even more explicit in their statement. We expected between 55 and 80 cents in GAAP earnings per share in 2026, and we are really confident about that. For perspective, with a PE ratio of 25, that would mean a stock price appreciation of 70 to 116%. Last quarter, on the other hand, they only talked about the annual growth rate in Q3, and they expect 17 to 19%, as I already mentioned. And there were no statements whatsoever about future quarters or future years, and that is a bad sign. And before we talk about the cons, and I have 3 slides of cons, I never had 3 slides of cons, we talk about the pros. The members and the numbers are growing. We know from Netflix, we know from PayPal, when the user growth is stalling, this is a really bad sign. The CEO Anthony Noto has been buying his own shares for the last 2 years, at least for the last 2 years. Other large stockholders are buying rather than selling. And 2.6% insider ownership is very low. I expect a little bit more usually. Now to the long list of cons. As I already mentioned, growth has stagnated for the last 3 quarters. 0 super investors have invested more than 3% of their assets. The outlooks given were not reaffirmed. They went from very confident that we will become profitable in 2 years to no outlook. And the dilution went up a lot, to 14% year over year. I really don't like to see that. The competition is huge. Before this analysis, I didn't knew that there were at least 10 other companies that provide similar services to the Galileo platform. This is why I assume there is no moat and there are no network effects whatsoever. And this is where I have to admit, I cannot assess the competition. I cannot assess how big is the total addressable market. How much can Airbnb and Shopify grow, how much other big companies will need to buy this kind of service. Why are they buying not from everybody else? So what makes this product unique or better than the competition? I really cannot evaluate that. What I also can't do is evaluate the company. Discounted cash flow analysis does not work since it's not profitable for long enough, and financial modeling of this kind of business I cannot do. Last but not least, the company is very highly leveraged. There is 3 billion in long-term debt compared to 6 billion in equity, and the company has to pay 1 billion in interest. This compares to 2.5 billion in revenue, so over 1/3 of the revenue goes directly to interest payments. And the last thing that is really a huge red flag, over 18% of the outstanding shares are shorted. So the bottom line for me is, while there are good things, little good things, there are many reasons not to be fearful and run away. My thesis now is, without growth, the company is highly in trouble and things will go south. So I decided to sell my position to avoid the risk of further losses. Now to the reflection part. SOFI was never accessible for me, not 3.5 years ago, not now. It should have gone to the too hard pile, and I changed my checklist. There is now a new question about competition. If I buy a stock, I have to take a look about the competition and do I understand it. Otherwise, I shouldn't maybe buy the stock if I can't assess the competition and the market share and stuff. This was my analysis of SOFI. It always hurts to realize losses, but in this case I really think the 30% that is left is better invested somewhere else. So last time I say this, like, subscribe, comment if you like this video, and see you next time.